Good morning, everyone. And I wanted to bring a worked example to the forefront of your mind this week. And this is from week 2, the end of module questions. And I think it's a great example in understanding the income statement and the balance sheet. And I believe it's a really important aspect of understanding financial statements analysis, as well as preparing you for some short answer questions and assessments in either assignment 1B or the mid-session quiz. So I wanted to run through we've got Swagman's scrambled list of accounts, and we've got to prepare an income statement and a balance sheet. So I've just got a little simple format over here to the right in Excel here. And what I'm going to do is first I'm going to go through and label each one of these accounts, and then we're going to copy and paste them into their respective area. So the first one here is easy. Depreciation expense, that is an expense. Next one, cash, that is a current asset. So current assets are those that are expected to be realized within 12 months or are turned into cash or cash equivalents inside 12 months. So because it is already cash, it has to be a current asset. The same thing goes for current liabilities. Current liabilities are those that are expected to be realized inside 12 months. So if you have, say, a credit account that you have to pay in the next 45 days, that would be a current liability because you're expected to pay that amount inside 12 months. However, if you had a loan with a bank that you're not expected to pay back for 5 years' time, that would be a non-current liability. And we have that here in non-current liabilities listed. Sales, that is income. Accounts payable, this is a current liability because this is an account where we would record our purchases. For example, like inventory, where we may have credit terms and don't have to pay for 30 days after we've received the goods. So inventory would increase, but also the liability for us to pay for that inventory would increase, and that's accounts payable. General administrative expenses, that's another expense. Property, plant, and equipment, that is a non-current asset. So they usually equipment and property and those kind of things, they're not expected to be turned into cash inside 12 months. If you are looking to sell equipment, it would go into a different asset account that would be a current asset. Notes payable, so this would be a short-term financing option that would be going into liabilities. Current liabilities. Current liability. Accounts receivable, this is a current asset. So this is when we have a debtor to the company. So if we've made a sale to a customer and they owe us money, that is an asset to the firm and is expected to be realized inside 12 months to be turned into cash or cash equivalents. Interest expense, so that is an expense, but that is going to be in a different area. So I'll show you where that'll be recorded in the income statement. Wages payable, so that is a current liability and would be associated with our wages expense account usually. But wages payable means that it might be some wages that we've accrued, say, for the month of September, but we're not paying the employees until the 15th of October. So we've already incurred the expense and we know we have to pay them. So that would be recorded on our balance sheet as a current liability. Ordinary shares is equity. Cost of goods sold, that's one of our direct costs and then goes into our calculations for gross profit. Inventory is a current asset, as we're expecting to convert that into cash or cash equivalents inside 12 months. Tax is another expense, and that's going to go at the bottom of our income statement. So I'm just going to put tax expense here. Accumulated depreciation is associated with our property, plant, and equipment. So it is what we've already expensed, and because equipment slowly becomes devoid over time or defunct, that we must slowly expense that asset over a period, and that's this accumulated depreciation. So that offsets the amount in property, plant, and equipment, and I'll show you how that works shortly. Tax payable, this is a current liability, as usually you are given less than 12 months to pay your tax bill for the previous year. It's usually sometimes around that 3 to 6 months mark for companies. Retained earnings, and that's just the profit amount from previous years, and that's actually recorded as equity on the balance sheet. So first things first, we're going to move all the income. I'm going to start with the income statement. So the first thing we have to do is sales, and I'm going to record the amounts here. Just going to fix the formatting because I like little commas in my formatting. I think it cleans it up very nicely. And as I do them, I'm just going to cross them out as we go. So cost of goods sold is a direct cost. And so now our gross profit amount needs to be calculated, and that is sales less our cost of goods sold. So we have a gross profit amount of $276,000. Now for our expenses. So we're going to put depreciation expense in. We're going to put general and administrative expense in. We can start putting our interest expense in, which happens at the bottom of the income statement. Just going to cross these off as I go. And I recommend you do this in the exam, as in any kind of assessment piece as well, just to ensure that you are not missing anything and misrecording, because that can really throw out your balance. So now for total expenses, we have to add these two amounts together. And then to get our operating profit, it is our gross profit less our total expenses. And then our profit before tax is our operating profit less our interest expense. And then our net profit is going to be our profit before tax less the tax expense. So that's our income statement amount for Swagman Proprietary Limited. And now we're going to move on to the balance sheet. So first we're going to do our current assets, because that's where we begin. So we're going to find all the current assets, accounts receivable, and last but not least, inventory. So I've just played around with the colors too much there, trying to get rid of the red text. And so then we can do our current assets by combining all the three of these here. And I've got a couple of formulas which I'll show you how they work and how they flow through, and that's how we're going to check that our balance sheet actually balances. So next we're going to do our non-current assets. So the first thing we're going to put in there is our property, plant, and equipment for $895,000. Now here's the tricky one. Accumulated depreciation is a negative non-current asset. So that isn't shown here, but it'll actually be a negative non-current asset, because that is the amount that we've brought down the value of our property, plant, and equipment by in our income statement, and that's technically what we call our net carrying value of the assets on our balance sheet. So that's probably what we could realize it if we were looking to sell the equipment. So accumulated depreciation is always a negative amount recorded in the non-current assets area. And so now I'm just going to, and $632,000 is the carrying value of our property, plant, and equipment for Swagman Proprietary Limited. Next on the list is we're going to do current liabilities. So first one off is accounts payable. Then notes payable. So they're short-term financing notes. Wages payable. And tax payable. And now we're just going to do our total value of total current liabilities is all of those combined. Then the next one is they've just put it all into one heading, is the non-current liabilities. So the value for non-current liabilities is $334,000. So that gives us a total liabilities value of $571,900. And then now we can put our equity amounts into the equity area of the balance sheet, which ideally, when a balance sheet balances, it should be zero. So the reason why it should be zero is that assets must equal total liabilities and total equity. So in this formula here, all I'm doing is subtracting I'm getting the assets value and subtracting the total liabilities and the total equity, and because that should be zero. So, and that's how we calculate our balance sheet. And now last but not least is, what do I say about the firm's financial condition based on these financial statements? So looking at it at the moment, I'd say the firm is actually in quite a healthy position. They have assets that exceed their liabilities amount, which is always a very strong position. Their current assets, so their current items that could pay for short-term liabilities, is more than double their current liabilities. And the fact that they've got net profit of $75,750 for the year that's recorded here shows that the firm is creating money and is creating cash. So feel free to post any questions you have about this worked example. Let me know anything, because I think it's a really important question in terms of financial statement and analysis. Thank you.